Welcome to this explainer. Today, we're uncovering the hidden code behind market movements by looking at a 130-year-old framework through a totally new lens. You've heard of Dow theory, right? Higher highs, higher lows, the whole trend is your friend thing. You probably learned it early on, drew the lines, waited for the breakout, and then, boom, watch the price reverse right in your face. Well, today, we're fixing that. 95%. That is the staggering percentage of traders who fail using Dow theory. Honestly, you might have walked away thinking it just doesn't work in modern markets. But in this explainer, we're going to explore exactly why that remaining 5% sees the market so differently. We'll see how they use this exact same framework to read institutional behavior at a level most retail traders literally never reach. So here's our roadmap for today. First, geometry versus market psychology. Then, the anatomy of a trend, followed by the 3 psychological phases of the market. After that, we'll look at spotting genuine reversals versus market traps, and we'll wrap it all up with a 5-step trading framework. Let's dive in. Section 1, Geometry versus Market Psychology. It's time for a massive mindset shift regarding what this theory actually is. Look, someone probably taught you this as a geometry exercise, right? Drawing lines on a chart, connecting dots, just waiting for a price to break through. But Charles Dow, he was not playing connect the dots. He was actually reading human emotion and institutional behavior. He was deciphering who is buying, who is selling, and exactly why the crowd behaves the way it always has. That single distinction, that's the secret of the 5%. You know, it's actually fascinating that Dow never even wrote a trading book. His observations from the Wall Street Journal in the late 1800s were compiled after his death into 6 core principles. And those principles, they simply became the DNA of every technical concept we use today. Market structure, trend following, you name it. But a heavily distorted, oversimplified version is what's being taught today, completely missing his original brilliant psychological insights. Moving on to Section 2, Anatomy of a Trend. Let's see how this builds into reading the market's true structure. Dow brilliantly divided the market into 3 distinct layers using an ocean metaphor. Imagine you're standing on a beach. The primary trend is the tide. That's the big picture direction lasting months to years, which you'll see on daily or weekly charts. Within that tide, you have the waves, or secondary reactions. These are the 33 to 66% pullbacks. This is exactly where smart money reloads their positions. And finally, you've got the ripples. These are the minor trends on those hourly or minute charts. Dow specifically warned us that focusing on the ripple of a 5-minute chart means you are just reading manufactured, unpredictable noise. And today, that noise is heavily manipulated by high-frequency algorithms designed specifically to hunt your stop losses. So the crucial point here is how we define structure within those bigger tides and waves. A valid swing point must be determined entirely by candle closing prices. Wicks lie. I'll say that again, wicks lie. A wick spiking above a high and then closing back below is not a new high. It's a liquidity sweep, engineered by institutions to trigger retail stop losses so they can fill their own massive orders. Structural changes absolutely must be based on closing prices. Grasp this, and you'll stop falling for false breakouts day in and day out. And honestly, that leads directly to perhaps the most expensive mistake retail traders make, confusing internal structure breaks with primary structure breaks. If you treat every minor swing low on a short time frame as a critical structure point, you are going to get constantly whipsawed. You'll get stopped out on completely normal, healthy corrections, all because you mistook minor ripple noise for a change in the primary tide. Always, always anchor your analysis to the primary time frame. All right, Section 3, the 3 psychological phases. Now we know how to define a trend, but we need to know exactly where we are inside its life cycle. Every major trend cycles through these exact 3 psychological phases. First up is accumulation. The market's been declining, the news is terrible, and retail traders are panicking and selling. But behind the scenes, smart money is quietly absorbing all that panic in a boring, tight, sideways range. Then comes phase 2, public participation. This is the main event. Price breaks out, momentum kicks in, volume expands, the news turns positive, and all the trend followers jump on board. Finally, we hit distribution. The news is absolutely euphoric. Everyone is showing off their massive profits online. And smart money? They use this giant wall of retail FOMO, fear of missing out, to quietly offload their positions at premium prices. Knowing your current location in this cycle changes everything. But here is the major trap. Accumulation and distribution look almost identical on a chart. They are both sideways ranges, they both have fakeouts. Context is absolutely everything here. A sideways range after a prolonged downtrend is likely accumulation. But an identical-looking range after a prolonged uptrend? That's likely distribution. Buying aggressively during a distribution phase because you mistook it for public participation is the exact mistake that destroys the most trading accounts. Seriously, if an asset has been trending up for months and the news is wildly positive, ask yourself, am I early here or am I the liquidity? Section 4. Genuine reversals versus market traps. This brings us to the ultimate question, separating profitable traders from the 95% who fail. So, when does a trend actually die? Dow's principles tell us a trend persists until there's clear evidence of a reversal. But, as we've just seen with liquidity sweeps and those lying wicks, we need to know what counts as actual evidence versus a trap set by institutional players. Let's break down the 3 scenarios that can happen at a critical swing low. Scenario 1, price wicks below the low but closes back above it. That is a liquidity sweep. It's a trap. Institutions push the price down purely to trigger your stop loss and fill their own buy orders. Scenario 2, price closes below, but the very next candle reverses back above immediately. This is highly suspicious. You've got to wait. Scenario 3, a strong body closed below the level, followed by continuation in the next candle. Now that is a genuine structure break on your primary time frame. But a trend rarely just snaps without warning, right? Before a trend officially dies, it leaves specific, readable fingerprints on the chart, telling us control is shifting. Keep an eye out for these 3 warning signs. First, diminishing impulse legs. The trend is visibly tiring out, kind of like a runner taking shorter strides. Second, deeper corrections, pullbacks that start reaching 50 to 70%, showing buyers are losing their sense of urgency. And third, failed breakouts, a sharp rejection right above a previous high with 0 follow-through. Now, here is a vital rule you need to burn into your brain. Weakness is not a reversal. A weakening trend can persist for a very, very long time. Seeing those warning signs we just talked about simply means you should tighten your stop loss and maybe stop adding to your position. It absolutely does not mean you should panic exit or aggressively reverse your position prematurely. You only trade the reversal when the structure officially breaks with confirmation. Which brings us to Section 5, the 5-step trading framework. Let's compress all this psychology and structure into a highly actionable playbook. By following these 5 sequential steps, you immediately eliminate fighting the primary trend. Step 1. Define the primary trend on the weekly or daily chart. Find the tide. Step 2. Identify the psychological phase. Are we in accumulation, participation, or distribution? Step 3. Wait for the secondary reaction, that 33 to 66% pullback. Never chase the initial impulse. Step 4. Confirm with context. Make sure volume aligns and those closing structures actually hold. And Step 5. Execute. Enter in the direction of the primary trend and logically trail your stop behind those confirmed closing swing lows. This brings us to the core realization of our explainer today. As the quote goes, Dow theory is not about drawing lines. It is about reading the psychology of a market full of human participants, making decisions based on fear, greed, hope, and panic. When you finally stop staring at the geometry and start seeing the underlying human behavior, when you recognize a wick as an institutional trap instead of just a line on a screen, this 130-year-old framework becomes the absolute most powerful tool you will ever use. So I'll leave you with this final thought. What was your biggest mistake with market structure? Was it trading the noise of the minor trend? Did you mistake distribution for accumulation and buy in at the absolute top? Or did you get shaken out by a wick-based liquidity sweep right before the market exploded in your direction? Think about which of these psychological traps has caught you in the past and use this totally new perspective to ensure it never happens again. Thanks for joining me on this explainer, and keep studying the psychology behind those charts.